5 secrets to get the best mortgage rates for you. That's the topic for today's episode. And without further ado, let's dive in. Hello everyone, and welcome back to another episode at NOVARISE Invest. And if this is your first time tuning into this channel, this is your channel for real estate education. So today we have a very special guest in today's video. He is an investor and also an entrepreneur in the US. And on top of that, he happens to be the chairman and CEO of Angelo Financial. What does that mean for you, you might wonder? Well, in any case, let's say you had a ton of questions about mortgages. You want to get some tips on what you can do to get the best rate for you, but maybe you were too afraid or maybe too embarrassed to ask an actual mortgage broker to get that type of information. So what we decided to do was to bring the expert in-house so we can ask all of the questions, all of the most common questions that I've encountered in all of the comments in our videos, and package that so that you can get everything in a one-stop shop in today's video. And without further ado, let's just jump right into the interview. And here we are, as promised, we have our special guest here, Angelo Christian. Angelo, welcome to our channel.
Hey, how are you guys?
Everyone is doing great, and I'm sure our subscribers are very happy to have you over here. And so we promised them in the introduction that you were going to share 5 amazing tips with them on how to get the best mortgage rate possible. So without further ado, I'm just going to pass the baton and have you just bombard them with your knowledge.
Absolutely. Yeah. Thank you so much. I'm very grateful to come on the show today, and I really appreciate that. You know, getting a low mortgage rate is very important. Right now, interest rates are really low, but there's some key things that you have to have in place if you want to get a low mortgage rate. The first one is you want to get your credit score as high as possible. Ideally, you want to have your middle FICO score at least 760 or higher. So the way that lenders, underwriters, and bankers, how they look at how they price an interest rate is based off your middle credit score. Usually everybody has 3 FICO scores. Their Equifax, their Experian, their TransUnion. And what you really want to do is get your credit score at least 760 or higher. So that's tip number 1. Make sure your credit score is at least 760 or higher. The second tip.
Before you move on, sorry, I didn't mean to cut you off. When you're talking about the credit score, could you specify which one? Because I know there's multiple variations of the FICO score, and I know there's some people who get confused with Credit Karma, and sometimes we have to tell them, hey, Credit Karma is not what the lenders are looking for. So maybe provide them a little bit of insight to that.
Absolutely. Yeah. So with credit, and this is great. I'm glad that you brought this up because this will allow us to go deeper. So the online credit reports they're good for people to look at, to monitor, but it's not the same thing as a lender's credit report. What the lender uses is usually something more in depth, more real time. Lenders, the module that they're generally using is anywhere from FICO score 2, 5, or 8. They don't use Vantage Score. They don't use Credit Karma. So the stuff that you see online, there's going to be a variation from what you pull on Credit Karma than what we would as our actual lender. So, and they're going to take the middle credit score. It doesn't matter if it's Equifax. It doesn't matter if it's TransUnion. It doesn't matter if it's Experian. They don't care which one it is. Right. They're just going to take the middle FICO score, right? There's no division. They don't add them all. A lot of people think they add them all up and they divide by 3. They don't do that. So they're just taking the middle score, whatever that one is, and that's what they're determining how to price your loan, how to approve your loan. And I will tell you, if there's 2 people on the loan, and they're going to go off of the lower of the 2 borrowers' credit scores. Okay. So this is an important fact. Let's say you and your spouse are going to buy a home, and the spouse has a 760, but the co-borrower has a 650. The underwriter is going to make the determination of the loan and the interest rate based off of the 650 credit score.
Wow.
Yeah. So it's very important that whoever goes on the loan, whether it's a co-borrower or a co-signer, that's the middle credit score. They're going to use the lower of the 2. And so the ideal credit score, the magic number is 760 or higher.
Great stuff. Thank you for clarifying. I appreciate that. And sorry to interrupt. I know you were going to go on to the second point, but I figure people are going to ask questions about, which one? Yeah.
No, it's good. I like to go into, I'm glad that you want to go a little bit deeper. So the second thing that is important is your debt to income ratio. So the debt to income ratio that you have is going to determine or could affect your interest rate. If you have a very high debt to income ratio, what that means is the amount of income that you have coming in versus the amount of debt that you have going out. So generally lenders like to see that your debt to income ratio is below 40%. That means after you factor in your new home and all of your debts and all of your liabilities, that your gross income before taxes is below 40% of all of your debts, all of your outflow. And it's a simple division, your debt divided by your income, and they want that to be below 40%. If your debt to income ratio is higher, like 50 or 55%, the lender could hit you with a higher interest rate. And you certainly don't want to have that because you're considered a higher risk of going into default if you're carrying on too much debt. So debt is very important. Lenders don't like to borrow to people that have a lot of debt because it looks like a high risk.
Right.
So what am I saying? I'm saying that before you have your credit ran, before you apply for the loan, check your credit report on annualcreditreport.com, where it's free and it's a soft inquiry. It's not a hard inquiry. Go through your debt on your credit report and pay down your revolving credit as low as you can, and then pay off your installments as low as you can before you actually apply for the loan. Because if your debt ratio is too high, it could affect you from getting approval, and it could also affect your interest rate.
Completely agree. Thank you for sharing that, Angelo. And just to clarify on something else, because we do have subscribers from all different kinds of level in terms of what they know about mortgages and real estate. So I just wanted to make sure they understand the differences between a soft pull and a hard pull or hard inquiry. Soft pull is just simply, it appears in your credit report, but it doesn't impact your credit score. A hard pull is what winds up deducting whatever score you have. So if, let's say, for example, you have a 720 and you go through a hard pull, then you might, next thing you know, within the next couple of days, you might see a 718 or something like that. So just for people to keep in mind.
That's right. Mm-hmm. Yeah, I mean, that's 100%. I mean, a lot of people ask this question. I probably get that question 100 times a day. Hey, is this a soft pull or a hard pull? And we have to explain exactly, what that is. So there's obviously some other things that are really important. Those are the first two tips. The third tip that's also really important is you want to be careful with how many inquiries that you've had when you're applying for a loan. This leads into the third tip is credit inquiry. So I think that when you're getting a home loan, you want to be careful about applying too many times to get a mortgage. A lot of people, what they do is they go online to like Lending Tree and they make the mistake to have their credit shotgun all over the place with multiple lenders. And if that happens, that can actually hurt your credit and pull down your credit score. So what I tell people, you definitely want to get a rate quote from a few different lenders, talk to a few different lenders, but you don't want to have your credit pulled, 10, 15 times, because if your credit's pulled too many times, that can hurt your credit score, pull your credit score down. And then the other thing is that it looks to the lender as if you're a high risk because maybe you got declined for credit. It's okay to get a few comparative quotes,
right?
But what you certainly don't want to do is just have all these lenders pull your credit, and then your credit score gets pulled down, and all of a sudden you had a 750, now you have a 680 because you let 20 lenders pull your credit. Usually, after you're talking to 2 or 3 lenders, you're going to know where you're sitting, right?
Right.
So you need to be able to control that. Just don't put your social out there online and let people run your credit. That's crazy. Talk to a few different lenders. There's nothing wrong with getting a few different quotes to get comparative offers, but be careful. And I really recommend keeping the inquiries to no more than 3 inquiries, whenever you're trying to get a home loan, because you don't want to have your credit score dragged in the mud. And now you went from a 3.25% interest rate to 4%. Because of all these inquiries that affect your credit score.
Right. And I'm glad you actually brought that up because it's actually quite common. We do get a lot of comments in our channel about people saying that, like, oh man, I wish I would have known this, I would have known that. Like my rate wind up being too expensive or too high because I got like 10 lenders pulling on my credit at the same time. So I'm glad you brought that up and that you're actually sort of like emphasizing on that so that everyone is aware, no more than 3. And then just shop around with the top ones that you are aware of.
Yeah, it's important. I mean, it really is. So the other thing that I want to kind of go into now that's important is we call it cash reserves or reserves. Mm-hmm. So reserves are important And basically what reserves is how much money, what's your liquidity? What is your cash, your assets? Lenders are not so much concerned about tangible assets like, well, I have gold or I have silver or I have a baseball cards or something like that. They want to know like, okay, what are your tangible liquid assets? How much cash money, your net, they call it your net liquidating value. What is the cash money that you have, stocks, bonds, 401k? And the more reserves that you have, it can help you to get a lower interest rate. Okay. So in other words, if somebody is buying a house to say, $1 million home, and after closing, they only have 1 month reserves. What reserves means is how many months of payments do you have left in the bank account after closing? Can you pay 6 months of mortgage payments after you close in case you lose your job? Can you float the mortgage payment? And if the answer is yes, they'll potentially give you a lower interest rate because you have more reserves, right? But if somebody is like a first-time buyer millennial and they're scraping to put the money together and they don't have a lot of money, sometimes the lender will modify or adjust their interest rate, and they could have a slightly higher rate if they don't have enough reserves. So reserves are very important because it helps the underwriter to reduce the risk, because they say, well, if this guy's got a year of reserves in the bank after he closes, he's a low risk, because if he does lose his job, he'll be okay. So we'll give you a 0.25% lower interest rate. So that's what reserves. So reserves are very important. Okay. I can't stress that enough. You always want to check to make sure. I say at least, ideally, to have at least, ideally 6 months of reserves after closing. So if your payment's $3,000 a month, how many months, how much cash do you have to have in the bank? How many? 18,000. That's right. 6 months of reserves. And if you do that, you can potentially negotiate to get a lower interest rate with your lender. Okay. So that makes sense, right?
Yes, it does. Thank you for bringing that up. And I think it helps the viewer kind of understand that, hey, if you're getting a rate, but you're worth more, you're worth getting a better rate that they're giving you, you basically just told them that, hey, this can be negotiable. You just didn't know that you can negotiate it. But now, right, you know that if their requirement is, like, for example, 3 months, but then you happen to have 6 months and you don't like the rate that you're seeing, you can actually show your bank statement and say, hey, but look, I got this in my bank account. Can't you get me like another discounted rate, or like at least make some type of like special offer for me? Because, hey, I can afford to, no, not afford, but I'm considered lower risk, right?
Right. Because see, and that's the thing, that the point that we're trying to expose today is some of the bank secrets. So we're giving you all this information and you're aware of it. You can go to your lender now, maybe negotiate a 0.25% lower rate because you watched this video. A lot of people, they don't know these things. Oh, well, did you know if you had 6 months of reserves or you had a 760 FICO, that you could potentially get a lower rate? The lender is not going to just openly come tell you this stuff, So because, I mean, obviously lenders, in our business, we get paid off of the spreads on interest rates. And so, lenders are going to try to, I mean, it's just the nature of the business. Mm-hmm. I'm not saying that's bad. I'm just saying that you need to be aware, because you can negotiate for a lower interest rate. Okay. If the market's at 2.99 and you have these additional compensating factors, now you can get a 2.6. It can save you 30 basis points. It can save you a lot of money on your loan. So, the next one that's really important that obviously comes up is the loan to value ratio. The loan to value ratio. So what does that mean, loan to value ratio? So essentially, whatever the purchase price of the home is, how much are you financing? What's your cash injection? How much capital are you putting into the deal, right? If you're buying a $300,000 home and you're not putting any money down, is that more risk or less risk to the bank, right? So, and this is something that you have to look at. If you're putting 20% down, which is the average in America for someone buying a home, you're going to get a better interest rate than if you put 3% down.
Of course.
Okay? So this is an important thing. Now, I'm not saying that you have to put 20% down. We do a ton of government loans where they have subsidized down payments, and there's nothing wrong with those. But I want you guys to be aware that if you don't put 20% down, you will pay mortgage insurance. And mortgage insurance in some cases can be very expensive. And so So if you want to get a lower rate and you can put 20% down or even more, you'll have more bargaining power to negotiate to get a lower interest rate. I promise you. Because if you walk into a bank or a mortgage company and say, I only have 3% down, you're going to be thinking about paying a higher interest rate. Okay. Because that's just how it works, because you're basically kind of showing the lender that you really don't have much. And I'm not saying that there's anything wrong with that, guys, but the basis of this video is to teach you how to get a lower interest rate. So you can get a gift for the money. You can sell things to get the down payment. But if you have the ability to do 20% down, then you don't have to pay mortgage insurance, and you can negotiate at least a 25 basis point or quarter interest rate lower by putting 20% down. So it's worth it. Like on a $300,000 loan, that's over $70,000 in interest difference. So it's a lot of money.
Yeah. And a lot of people sometimes fail to see that because it sounds like it's such a small percentage. It's only a quarter point. It's only 0.25. But then when you add all those interest payments over the span of 30 years, which is usually the average mortgage length, we're talking about a lot of money that you can, do so much more with it if you didn't have to pay it down on interest.
Yeah, and the thing is that and one thing I will tell you too is that if in the beginning, if you don't have 20% down, I'm not saying that you shouldn't buy a home. A lot of people, what they do is they'll buy a home with a government loan, and then they'll come back later and refinance the conventional or something and take off the mortgage. That's okay too. I'm not discouraging home ownership if you don't have 20% down. I'm just saying that have a plan. What we do a lot with some of our clients that are first-time buyers is we'll do FHA, and then we'll come back later and refinance the conventional to take off the mortgage insurance. So that's a good idea too. So yeah, because not everybody has. This is an interesting statistic by MIT. It takes the average person 13 years to save for a 20% down payment. You know? And so I'm not saying that we need to be renters. I'm just saying that, if you do want to get a lower interest rate, that's kind of the metric in the lending industry is 20% down, 80% loan to value to get a lower rate. So, this is an important topic, and then I do have one bonus one if I can bring that up.
Oh yeah, sure.
Okay. So good. So there is one last one that is really important, is that when you're shopping for a loan, one of the things that you want to be mindful of is you don't want to disclose to all of the lenders that you're talking to them that you're shopping for a loan, right? So if I'm talking to you to get a loan, and you don't want to let the other lenders know that you're talking to another lender at the same time, okay? Because what you want to do is you want to get their quote. Like you talk to Angelo Christian, I'm getting a quote from Angelo Christian, and then I want to talk to Movement Mortgage. I want to get a quote from Movement, and then I want to get a quote from Wells Fargo, and then see what the different quotes you're going to get. You're going to get a loan estimate, and the loan officer is going to disclose to you a good faith estimate, and it's going to have all the terms on there. But you don't really want to share that information with all three of them. A lot of borrowers or people, they will, sometimes include all the lenders on the same email or let them know that they're working with three lenders. And it can get kind of messy, and you could probably lose a deal or affect one of the lenders backing out. What you really want to do is just let them know that, hey, I'm interested in getting a loan. Can you give me an estimate? There's nothing wrong, immoral with getting a few different quotes. I mean, it's natural. Everybody talks to a few different companies, just like when you're getting car insurance or buying a car from a dealer. Right. And a lot of times I will tell you that a lot of people do business with people that they like and that they trust. And sometimes they'll pay a little bit more because of the relationship. I'll tell you, me personally, I'll pay a little bit higher if I like the person I'm dealing with better. That's how if I have a personal connection with somebody. So the relationship is very important too. Not just the interest rate. I mean, I wouldn't go with someone just because they had the lowest rate, but I didn't like the person I was dealing with. You know what I mean?
Yeah, completely agree. I think it's just a combination of multiple things. But to your bonus point, I found that to be amazing because it's funny how most of us tend to think like consumers, right? Like the whole price matching. Well, if I go to Best Buy and I don't like what I saw, and if I can pull off something from Amazon and say, hey, would you do a price match? Chances are Best Buy will probably do that. But on mortgage, things might work out a little bit different.
Yeah.
Yeah. Mm-hmm.
Yeah. I mean, because like, for example, I mean, I'll tell you that, we're a direct lender, or we are a nationwide direct lender, and we have great rates, but we're also big about service. Like, we're open 7 days a week, from 9 a.m. to 9 p.m. I mean, we do loans in Hawaii, New York, Alaska, Puerto Rico, Florida. And so we cover the whole gamut, and you deal with my company. My office is right, this building behind here's my office. That's my building right there in Houston. And so, we've been doing this for 20 years. Are we the cheapest rate? We're not the cheapest rate, but what you are going to get is real people that are genuinely trying to help you to get you the best loan. And we have a ton of different products and programs to help people. And that's really how we're different, right? We scour the earth to find the best programs, the most innovative loan products to help all you guys out there. So.
And of course, I mean, we can tell based on the quality of the information that you have provided to us today. If this is just a sneak peek of what you have to offer, imagine what it was like to just get in touch with you and your team. So for those who are actually interested in getting a quote, reaching out to Angelo or his team, regardless of where you are, you heard him yourself. He has a license to practice in all 50 states. So now you don't have to worry about, hey, is this person in my state? Is this person in my hometown? All you got to do is just to click on the link that you see on the screen or in the description box below, and just simply get in touch with Angelo and his team, and someone will get right back at you. And while everybody does that, and jot down the link, or you're trying to fill out the contact me form on the screen, Angela, could you please just share a little bit more with everybody as to what they can expect from the moment they fill up a form to the point that, let's say, close out a loan in the event that they do go with you?
Right. Yeah, I know. Absolutely. Thank you so much. So basically the process is, once you click on the link, you're going to fill out the information. Then a licensed lender will contact you right away. We'll go over your goals. We'll have a pre-screening, talk to you, learn about what are you trying to accomplish? What are you trying to do? We're going to try to understand, learn about you, what is the home that you're looking for? We're going to, go into your financial situation, your credit situation, and essentially pre-qualify you, right? Find out if you're trying to buy a home in Florida and it's your retirement home, tell us what type of home you're looking for. We're going to go into your credit, your income, your assets, talk to you about these different things, and basically come up with a game plan, a solution, or multiple solutions on how to help you. From there, after we have that consultation, we're going to send you a checklist. Okay. Just like in any industry, any business, there's some type of checklist or order or procedure. And so we're going to send you this checklist based on your situation of the things that we're going to need from you, whether it's a no documentation loan or a HELOC loan or a jumbo loan or an FHA loan. You're going to have a checklist tailored to that. And then you're going to gather up those items, and you can either securely upload them to our portal, or you can send them via Dropbox or Google Drive, or somehow you're going to get these documents to us. And that could be anything from, pay stubs, W-2s, bank statements, tax returns, credit report. And then basically that's going to go over to a lender, and that lender is going to review your file and then come back to you within 48 hours for a credit decision.
Wow, okay. 48 hours is pretty quick.
Yeah, 48 hours. Sometimes it could be 30 minutes. Oh. So yeah, it just depends. It just depends. Like, today we probably pre-approved about $20 million in business, and a lot of it was done within an hour.
Wow.
So some files, some cases. Now I will tell you that, we're dealing with all different types of people. And some of them, they take a little bit longer. On average, the average review time is 48 hours. Some people's cases can take longer. And some can be instantaneous. It just depends on the file and what we're doing. So what happens after that, after the credit decision comes back, you're going to get a pre-approval letter from us. It's going to be from our mortgage company. It's an official certificate that you'll get to share with your realtor. Now we are a realty company too. You can work with our realty company, or you can use your own realtor. And then you're going to get this official approval letter signed by the loan officer. And then you're going to take that approval letter to start shopping for your house. So that approval letter, the approval letter gives you the power. It's the money that the bank has set aside for you to purchase your home. And it shows the realtor that you've been approved for funding. Okay, because the seller doesn't really want to deal with people or the realtor if you haven't been approved for the loan. They want to make sure you've been approved. They don't want to, show you the house, take the house off the market, go under contract. They want to make sure this person was approved for the loan. So we get all that out of the way. The approval letter shows Mr. Jones, X, Y, and Z has been approved. We verified everything. And then they give that approval letter to the realtor, and that allows you to shop. There's no commitment. There's no obligation. You don't pay anything to apply, but you have the power now to be able to purchase a home and go shopping, like an Amex Black to go shopping. So, and it gives you that privilege. And so now you're not under any obligation, but if you find a house and you go under contract, you'll sign a contract with the realtor to purchase the home, and then you'll go into escrow, and then you'll send us a copy of the contract, and then we will process and close the loan. And what does process and close loan mean? That means that we're going to order inspections. We're going to order appraisals to make sure that the property is legit. There's nothing wrong with the property. That it appraises out fine, because you don't want to overpay for a house, and you're going to hire a licensed inspector to go to the house to make sure that the property is okay. The loan's going to go through underwriting. There's different levels of review in the home loan process. There's the pre-underwriting, what we did to pre-approve you, and then there's the final underwriting. After the loan gets pre-approved, you go under contract. The next step is you're going to request a loan commitment. And this is one of the final stages of loan funding. The loan goes before the underwriter, just like when you see it on court, you go before a judge. It's kind of like that. You go before an underwriter. They're licensed by the bank or licensed by the government agency to make the loan. So they review everything with a microscope. Now, some loans are different. Some loans, like no documentation loan or asset-based loans, there's not really, the microscope's much bigger. But for most loans, the microscope is very narrow. And they check a lot of stuff. Hey, what did you do for this deposit over here on this date? Why does your pay stub have that? And you have to be open and willing to be able to go through this process. And it is somewhat invasive. And but you have to embrace it if you want to get a loan. And I didn't make the rules for this. It's just part of the process. They're going to ask you questions, and you have to feel comfortable to answer those questions. And so once you get over that hurdle, I promise you it'll be fast. You'll actually get a loan commitment, and that means you've been guaranteed to get the loan. You've been blessed and anointed by the underwriter, and now you have a loan commitment guarantee. That means that there's no more questions, and you're going to close. Yeah. And then what happens after that is you're issued something called a CTC, which means that your loan has been cleared to close. Mm-hmm. And then your loan will go to docs, which is you'll go to the final attorney, and they'll prepare the loan documents for you to sign and go to a title company, an escrow company, to sign on your documents and close on your loan. Now, if you are bringing any money to closing, that money will be brought to closing at the attorney's office or the title company. And you'll go there to meet the attorney, the escrow officer, potentially the seller, possibly your realtor. It's a table. It's called a closing table, like a dinner table. And everybody meets up, and you sign your final loan documents. And then you take title to the property. We give you a mortgage, and you get the keys to your house. The loan funds, we send the money to the seller. You get the property, and bada bing, bada boom.
Amazing, amazing. I couldn't have done a better job explaining. So for those who had a slight chance of maybe even doubting Angelo, now you know, like, this guy is the expert. He walked you literally step by step as to even what to expect. And he even helped you picture yourself at the closing table, getting the keys to your property. So amazing. There you have it. The link is still on the screen. So make sure you click on the link down below. So that way you can get in touch with Angelo or anyone within his team. And remember, he's licensed to work in all 50 states, and you don't have to worry about having to step out of your house anymore. more, and just simply do everything at the comfort of your home. So that's pretty much all we have for today. Angela, is there anything else you want to tell everybody before we say goodbye?
Yeah, I mean, I just want to let you know. So one of the things that's important that I want to really emphasize on how we're different. We have a Vegas buffet of loan products. So we have programs like, for example, we have jumbo loans with only 5% down. Most lenders want 20% down for a jumbo loan. So if you want to buy $1 million property in New York, you don't have to put 20% down. You can just do 5% down and pay no PMI. We have no documentation. Maybe you're self-employed and you can't show your tax returns. Right. We have no paper loans. You just, if you know, so you don't have to show your taxes. We have loans if you don't have a social, maybe you just have a tax ID. So we have very exotic, very creative loan programs to help many different types of people. Where a lot of lenders are very strict and they have a lot of requirements, we really try to go above and beyond to deliver to all of you guys out there to give you great programs, great service.
Excellent. You guys got it. You heard it. If you're having any, let's say, issues or hurdles and any of the other lenders that are not willing to work with you, now you have the expert right here who is willing to create something, well, not create, but like provide you with a big source of different financial products that could match your needs. All you got to do is just to simply reach out to him, and either himself or anybody from his team will be getting in touch with you. And the best part is that you don't even have to step out of your house. So take advantage of this and do it now. So that's pretty much it. That's all we have for you today. Hopefully you enjoyed the episode, that you actually learned a lot, and you also learned a lot about Angelo and his team and what he does. And that's pretty much all we have. And until then, we'll see you guys next time. Take care. Bye-bye. Okay.